Howdy, Jacob here. Today we're looking at DMC Global, company 110 of our generic stock screener. It is in the energy equipment and services industry. 285 million market cap on 350 million enterprise value. So there's a little bit of net debt. It is a fairly small company, so I'm trying to look at insider ownership, and I see about 5.9% insider ownership. Obviously, I like 10%, but 5.9 really, in all honesty, is not that bad. Meaning that people on the board, people who are running this business have a stake in the business, so they're likely going to do what's best for you as the shareholders. They themselves are hefty shareholders. So price to book 0.5, interesting, 13 PE. Growth is actually very impressive. 203 million in 2014 in revenue to 719 million in 2023. But it was all spawned from the last 2 years, really. So went up, went down, pretty volatile revenue I'm seeing, and also earnings negative 0.3%, 1%, as high as 20%. So you're going to have to average out what you think the return is going to be since it's a pretty cyclical business. Balance sheet shows about 44 million cash-like products with 15 million short-term debt, 100 million long-term debt. That $100 million in relation to their 5-year average free cash flow isn't that much, probably 3 years of their 5-year average. So really not concerned about that. And it came about because this acquisition, it looks like, and then they've been paying back 15, 17, 39 million a year, which is awesome. So it'll likely get down to a ratio that's very reasonable, and then they can focus on capital allocation of reinvestment, share purchases at the right price, and then acquisitions that are advantageous. So majority of the money right now is going towards debt reduction, a little bit to reinvestment, share repurchases, outside of that huge acquisition in 2021. But it does look like that created a bit of free cash flow, so we'll see whether that's going to stay or not. I mean, increasing your cash flow $30 million for 261 million is a pretty solid investment. And if we look at, I think we're ready to make some assumptions, honestly. So let's do that. So revenue growth, I mean, it's very cyclical, kind of all over the place. Made a huge acquisition here. Went into debt for it. I mean, yeah, maybe 5%, and then 15. Let's do roughly market average price to earnings and free cash flow. For margins, they're not very high. I don't like that as much. Maybe let's do 4 and 5% with a share change of probably zero. We'll say they offset their stock-based compensation with using 25% of their free cash flow. So this would have maybe 20% of free cash flow to share repurchases to offset stock-based compensation. You got about maybe 30% to debt, leaving a solid chunk of their free cash flow to reinvestment and acquisitions that makes sense to get these types of returns and these types of margins. And we're really saying it's only 17% off from where we get the return we're looking for here. So I'd definitely be interested in the margin piece. I think outside of that, I feel good about the rest of the assumptions. So probably not too long until I do a deeper dive here, but hope you enjoy the video. Have a great day. Thank you.